Hi, Matt McAleer, Director of Equity Strategies, Cumberland Advisors, April 8th, just after the close, with Shaun Burgess off of our Munis desk, where Shaun's a portfolio manager, and you've met Shaun before talking about what he's seeing from a bid offer, from a inflow-outflow scene, and we're going to get some color from Shaun in a moment. Last week, I mentioned that under the hood of the equity markets, we're starting to see some positives, and I got a couple of notes asking me about that. So I decided I'd go to my handy charts and we'd review a couple things today. First chart I'm going to put up there is of the 10-week S&P 500 point and figure chart I like to use. What the 10-week is a measure of the percent of stocks within, in this case, the S&P, that are trading above their 10-week moving average. All this is trying to show us are stocks trying to stage an uptrend. And in terms of what we're looking at here in the 10-week chart is what I was discussing last week. You can see in that yellow circle the action we've seen over the last, let's call it 3 or 4 weeks. Good, solid uptrend. We're at the peak of that column of X's. We had 74% of the S&P trading above their 10-week moving average. There's nothing special about a 10-week moving average other than it's a popular statistical measure in equity trading. All we've done from there is back off that high. What we'd like to see is for this number to get sticky here. We'd like to see greater than 50% of the equities in the S&P 500 trading above their 10-week. That would show participation. That would show the fact that we're certainly not out of the woods, but at least we're getting some forward movement. The problem, and I'll get to this next week when we show a couple of charts that I'm not thrilled with. The problem is most of this action's being carried by defensive sectors, which net in the long run doesn't tend to have legs for too long. So let's take a look at the S&P 500. There's another chart coming up here. This is the S&P 500 index on a point and figure chart. Again, I've circled the action of this year. And you can see at first glance, when you look at the S&P here, that's solid action. It's not action that you need to get overly concerned about. Why not? We see a couple of higher lows. That's where we see those columns of O's ascending. We see a break higher in the right-hand column. Now we're pulling back off that column of X's. What we want to see is another higher low. So those are some of the things under the hood that give the market some positive tone. We're going to take a look next week at some things under the hood that are concerning, because it's always the same story. What can go right? What can go wrong? Charts don't predict anything. And often people make mistakes of getting too glued in on charts. Charts are about probabilities and possibilities. They do not tell you what's going to happen. But what we try to do is take multiple price points, multiple analytics, and try to get a feel for where the market's going. So Shaun, let's jump over to fixed income. I know you had a bullet point you sent out to us earlier today talking about the real outflows out of fixed income in general. That when we say fixed income, maybe I should be more specific, Treasuries, corporate bonds, right, and muni bonds. So we're seeing outflows with some fear of higher rates. Maybe at the exact time there should be inflows instead. Maybe the outflows should have been at 140 on the 10-year, not at 270. But tell us what you're seeing in muni land.
Yeah, inflows are something that we've talked about in the past, and they're something that we keep a really close eye on. So what you see is funds, ETFs, generally they have to sell what clears the market. They don't sell what they want to. So it tends to be a good time to go out, pick up some deals, be opportunistic, and you really get your pick of some good bonds that have to get sold to meet redemption. So in the past, when we've seen this before, it tended to be a really good opportunity. We talked about lengthening duration a little bit. buying some longer paper, and this just gives us some rationale to go out and to maybe do that to a greater degree.
Sure.
As we see those outflows.
Nibbling on that long end, right? And we talked about this 2 weeks ago, I guess it was. You don't flip a switch and just start buying 30-year bonds and saying this is the peak in yields.
No, you don't know the peak.
You don't know the peak, but you can start putting it out. What does that do to the client's entire portfolio, right? Yields start to rise.
Yields start to go up, which is incredibly powerful. As time goes by, those higher yields are really, as a compound, really provide a lot to the portfolio. Means portfolios get a little bit longer, not overly so. We're not going out and just, as you said, buying all 30-year bonds, but we're really looking for value in here, trying to find those 3.5%, 4% type yields where we can get them, where the market gives them to us. And this week in particular, we saw a large outflow. Didn't really see that much in the yield side of things on the trading side, but that's what we're looking for. Really trying to be opportunistic here and pick up those, as I said, 3.5% to 4% yields tax-free on a ratio to Treasury basis we think are very attractive.
Right. Good. We'll keep looking at that. The other thing I wanted to touch on, because it covers both equities and fixed income, there's been an awful lot written about the 60-40 portfolio and how difficult it's going to be to make money going forward over the next decade. And I want to mention to clients, to listeners, a 60-40 portfolio static is very different than a 60-40 portfolio that is rebalanced at certain price points to take advantage of sell-offs in an equity market or a bond market. So I'm going to go into some of that 60-40 work over the next couple of weeks as well. Enjoy the weekend. Don't forget to like, comment, and subscribe. Turn on notifications, and we'll be back at it on Monday.